Welcome to another Facebook Live. I've been anticipating this one for a while. We have our favorite returning guest here, David Rosenberg. He is the founder and president of Rosenberg Research and Associates. He's been analyzing the economic and market strategies for more than 30 years. And he's also the author of one of my favorite morning newsletters, Breakfast with Dave. So welcome to this Facebook Live, David Rosenberg and Barry Habib.
Great to be with you, David. So it's amazing that a year has passed since we kind of did this last one, and who knew what was about to happen, right?
And nothing changed.
Exactly. But David, listen, I want to just jump right in because we've seen a pretty sharp rise in the 10-year Treasury yield. We're seeing mortgage rates rise, and a lot of the people that are watching this really want to get your take and your opinion on where you see interest rates maybe in the shorter term, intermediate term, and longer term.
All right. Well, look, in the shorter term, you're usually gripped by technicals and fund flows and momentum, the sort of things that are basically transitory. So if we're going to talk about what could happen on a near-term basis now that the 10-year has crossed above 1.5%, it stayed there. We got above 1.6 for a brief period of time. And my sense is that we could still see the markets spook, not just by some of the upcoming, headline economic numbers with all the stimulus, but also just the base effects from last year are going to drive the inflation rate probably up to as much as 3.5% by May. The question is how many people really know that. I think they'll be surprised. So I think that, and this is coming from a longstanding bond bull, we could still see near term some upward pressure on bond yields based on the cyclical part of this, and inflation expectations, which are high, may end up going up further. So I'm not in the camp that thinks we're going to 2.5, 3% on the 10-year note. But at this stage, can we get to 180, 190? Well, Barry, I mean, that's where we were pre-pandemic, and everything is pretty well back to where they were pre-pandemic, whether you're talking about commodities or oil or the stock market or credit spreads. Everything is pre-pandemic. So there might still be, if you're talking about the next 20 basis points, I think it's probably going to be up. Is it going to be a great buying opportunity? Yes. I think that if you're talking to me about the next 100 basis points, not the next 20, I think it's more likely to be down than up. And I think that a lot of the inflation scare that's in the system right now is going to prove to be overdone. The Fed is not going to be tapering. The Fed is not going to be raising rates anytime soon. And what people tend to forget is, they're looking at the reopening of the economy, creating demand-related inflation. They don't see that the supply is going to come back as well. And look, I've lived through this too many times. I'll just finish off, Barry, by just saying that, look at, how many times have we watched this same movie? These same people saying, sell your treasuries, inflation's going up. These are the same people. They could take out their slide packages from a decade ago. It's the same slide package. We had 10 of these bond sell-offs from 2009 to 2019. The whole way through, the 10-year note went from 3.5% to below 2%. We had 10 of these spasms, and the average increase was 100 basis points, which is about where we are right now. So as painful as it is, if you're long duration, I would still say stay the course. I don't think the next big move is going to be up from here, although I'm not going to say that we haven't hit the peak just yet in the 10-year, but we are getting to a very nice re-entry point if you're an investor.
That's really good news to hear. So I want to show you a couple of things. So first of all, I'm glad that about your take on inflation. I want to show you some work that we've done, and I want to get your opinion on it. But before that, we had, from a technical level, and we do a lot of technical work. We did a long time ago identify 160. It was actually 160 and a fraction. We hit pretty much exactly on that Fibonacci level. We backed down, and what we see is if that does break, we're going to 197. That's the next level. You call it 2%, which is, I also think, right in line with what you're thinking. But I want to show you something here that we're working on here. And Megan, you got to allow me to share my screen, please, so that we can do that.
Sorry.
What I'd like to show you is the work that we've done on inflation to show pretty much exactly what you had mentioned with respect to it being transitory. And in addition to that, where we think they're going. Now, we don't think 3.5%, but listen, we could be wrong. But I want to show you where we are. And Megan, would you just give me that capability if you can?
You should be able to share your screen now.
Nope, cannot. All right, so let's go on to the next thing while Megan gets that figured out for us, and you'll tell me when we're good, Megan. But for right now, David, let's talk about where you see the stock market, because it is, by all accounts, probably one of the most expensive stock markets, if not the most expensive stock market ever. But yet a lot of money from stimulus could find its way to the stock market, push it higher. What do you see? And we're going to get back to more on interest rates. What do you see as far as the stock market at these levels? Do you think it continues to run hot? Do you see a big change coming? I know the NASDAQ's almost in kind of correction territory. So where do you see things?
Well, look, I mean, valuations, even at extremes, I think provide a constraint on your expected return, but it is by far the furthest thing away from a timing tool. You only really look back at valuations after the fact. The question is, what are the black swans or what are the gray swans out there? Usually when the stock market goes down, there's some sort of shock that causes it. Late 2018, we had a monetary shock and the Fed flattening the yield curve, tightening liquidity, and the market was down roughly 20%. We had a exogenous health shock. We saw what happened last year in February and March. But the market doesn't go down just willy-nilly. There's got to be some shock that provides it. So if it's not going to be interest rates, and I'm not overly concerned because I don't think the Fed is going to be ratifying this move up in bond yields. The question is going to be, I think for me, and what I'm saying, Barry, is that I think that the stock market, and this is from somebody who's quite cautious, we probably have a free pass up until June or July. Because when I'm taking a look at right now, I mean, rates have backed up, market rates have backed up. There's been no big market reaction. I mean, there's been that rotation from growth to value, and the cyclicals are doing well. I think that what could undo this this rally will be how the second half of the year shapes up, because the market has gone ahead to price in gargantuan growth. The vaccine's getting rolled out. We're all going to reopen the economy, and it's going to bump against this gargantuan fiscal stimulus. So we're going to get a couple of quarters of incredible growth. I think that should be in the markets right now. Everybody knows that. And that's probably a second and third quarter phenomenon. So the question is going to be, post-summer into the fall, whether or not we're going to have follow through on that growth.
David,
the extent to which the stimulus gets saved or spent, I mean, there's still question marks. But I think what's going to happen, and look, when you go back to when the tech wreck began back in early 2000, it wasn't about interest rates. I mean, the first part of the market that went down was NASDAQ, which by definition, shouldn't have been influenced really by interest rates that influence, more the cyclical part of it. It was when the tech stocks started missing on their earnings estimates. That's really what started happening, was the disappointment in terms of what was priced in not coming to reality. And I think that's the big risk for the second half of the year. Outside of that, it'll have to be some sort of credit event. I'd say that, everybody focuses on, is the Fed going to do a taper? Is Powell not concerned about the run-up in bond yields? They're only concerned if it tightens financial conditions, and he basically said that last week. And that's code for widening credit spreads. It was widening credit spreads is really the bellwether leading indicator for equities. So that's what we want to keep your eyes on, is if rates back up enough to upset the apple cart on the economic outlook, you're going to see it in credit spreads, and that's what's going to filter through into a correction in the stock market.
So now that we know that one of the key drivers is going to be credit spreads and seeing interest rates move higher, let's take a look and tie in the inflation picture. So what I'm going to do is I'm going to share with you what we've done as some work on inflation. Now, I'm using here the core CPI, which we're going to get tomorrow. So I know the Fed's favorite measure is PCE, but the CPI is something that's still very closely watched and followed. And it's something that, as I mentioned, we'll get news on tomorrow. So we're going to assume for a minute we get 0.2% on core CPI tomorrow. And when we get the year-over-year number of 1.4, essentially what it does is it looks at the last 12 months. And when we see tomorrow's report come in, we're going to get that 0.2%, should give us 1.4% year-over-year inflation. But then if we continue to assume, and I get this is an assumption here, 0.2% per month, then what starts to happen? When we get the report in for the month of March, that'll be released a month from now, that'll be released in April, you're going to replace March of 2020, which was flat, with the assumption of 0.2%. That will drive the CPI up to 1.6 on the core. But now let's take it to the next month, because look at April, look at the comparison. This is where it gets really interesting. And in April, if you replace -0.4 with +0.2, this is going to show a year-over-year inflation reading of 2.2%. You do it one more month for the month of May with another comparison that was negative of down 0.1, and you've got 2.5% year-over-year inflation. Now, David, here's the thing. We've got mortgage rates today, let's call it 3.25 as just a ballpark number, with core inflation on the CPI at 1.4%. If core inflation on CPI gets to 2.5% in just 3 short months from now, right, will we still see mortgage rates and the 10-year Treasury where it is today? Because here's what we're looking at. If we're looking at this month's CPI year over year being 1.4, next month's 1.6, and then 2.2, 2.5, 2.5. The good news, and David, this coincides exactly what you're thinking. And by the way, I always love when our kind of thinking is something that you're thinking the same, because it gives us a lot of value in the fact that we feel that when brilliant minds like yours are kind of seeing it similar to us, it makes us feel pretty good about where we are. We think that, as you said, David, in June and July, now I know you think it could be higher. That's because we're only assuming 0.2% inflation per month. We could get hotter numbers, and that would push this to maybe 3% or more inflation. But then the real important thing, David, is we see it cooling down towards the second half of the year, where inflation will be less of a concern. So just your thoughts on that, first of all, David, and do you see it similar to where we are there?
Right. Well, I was talking about headline inflation when I said 3.5, as
Gotcha.
opposed to, and you're going to get a lot of that energy pass through in the headline that escapes the core. So, look, I think that is a nice fun with figures sort of analysis, but it's very short term. I mean, inflation is a process. It's, to me, it's not like 2 or 3 months. Are we going into an inflationary cycle, or are we not going into an inflationary cycle? I mean, we had 2 different periods in the last cycle where core inflation got to 2.4% year over year, and it wasn't sustained. And in a period of time when the labor markets were a lot tighter. I think that, we actually bottomed in the last cycle, 2010, at 0.6% on the core. The peak, pre-pandemic peak, was 2.4. Went from 0.6 to 2.4, low to high. Was that the story? Was the story that we actually went, because of base effects, because of commodities, we went from 0.6 to 2.4 from 2010 to 2019. Was there anybody that would ever call that an inflationary cycle, that last cycle? No. The bigger story was that 2.4% peak in core inflation was the lowest peak in core inflation that we've had in 80 years.
Yeah, but David, we don't know it's the peak until you're in the rear view mirror, kind of. But
what we know, and this is actually not the near-term chart; it's a long-term chart. We know, cycle in, cycle out, that core inflation is peaking at lower and lower levels. The peaks are getting lower and lower, just as the long bond yield, the 10-year, are getting lower and lower. And it's because of the structural disinflation factors that haven't gone away because of the pandemic. Now, look, we're going to get some near-term inflation. We had this is a very special period of time. We had, you showed the negatives from a year ago, and a lot of this is base effects, but think about the negatives a year ago. The economy shuts down. We have an initial demand implosion that superseded the contraction in supply. So what's happened is because everybody freaked out over supply chains and lack of material, we've gone through a very significant inventory cycle in a short period of time. And you see that in the supply delivery delay numbers in the ISMs. So we've had this massive inventory buildup, people trying to buy material, fears of shortages, and that's what's driving a lot of this. And look, we're going to get demand, but the supply will come back. This is all very short-term in nature.
So David, we agree with you. We agree with you on that.
Well, the fundamentals are what? Aging demographics, technology, and the fact of the matter is that we just have too much debt, and we have more debt now, and the credit multiplier has been broken and is fundamentally disinflationary. So I'm looking at this very near term. I understand the reasons why we're going to go through a near-term blip on inflation. This is not the first time. I've been in the business 35 years. I've seen these before, and these are basically deviations from the trend line, but the trend line hasn't changed.
I get you, but here's the thing, David. So first of all, we're in complete agreement with you there. We have, our forecasts have all shown that. We think that we're in for potential recessionary period 2022, 2023. We think the 10-year might hit its lowest level. So we understand the effect of debt. We've been explaining that to our subscriber base for a very long time. The question I have for you is this, is that while we talked about that peak in CPI before, for that interim period, interest rates did rise. So my question to you is this: will the bond market, because remember, the people that are watching this, they've got to think about their client base, and they don't have years or several months to make a decision whether that client should be locked in or not, or to plan for their business. So we have to know that. This is my question to you. In the next 60 to 90 days, as the rate of inflation rises, do you think that the bond market will view that as saying, okay, we know it's going to come back, and therefore we don't need to have a higher compensation by charging a higher rate because of the inflation? Or do you think the bond market's going to look at that and say, well, we don't like this, even though we know it might back down later on, we just don't like the smell of this right now, so therefore we've got to get higher interest rates that we're demanding right now, causing mortgage rates and maybe the 10-year treasury as well to rise during that period? Because that's the question that people that are watching this really want to get your opinion on.
Well, look, our bond duration model, our proprietary bond duration model, and we just published our strategizer publication today, is flashing green. Doesn't mean that you can't have a yield overshoot. I mean, Barry, look, we for a temporary period of time, we got to 4% on the 10-year note from 2.5% in a period of 3 or 4 months back in 2009, 2010. We had 2 runs at 4% with the funds rate at 0. So I'm not going to sit here and say that the technicals and momentum and look, I have to decide, you know, what side, like who's winning? Is it the sophisticated investor that really understands the inflation process trading bonds, or is it the unsophisticated investor that's going to actually make decisions based on something that is a lagging indicator like the year-over-year inflation rate or year-over-year core? That is basically telling you what has already happened. Now, maybe the market chases that. I'm not going to say it can't. But what I will say is that if you're telling me in the next 6, 12, 24 months, I think yields are going to come back down. 2 or 3 months, you know, who knows if people are going to, and I say the unsophisticated crowd might get scared because they see these headline prints. I think that I'm a willing buyer for those people that want to sell, because I understand that inflation is a process. Inflation is not 2, 3, or 4 months. And I can understand that people might get spooked looking at the year-over-year numbers. But I understand what brought us to these numbers is what brought us to the negative numbers a year ago. The negative numbers a year ago were due to the pandemic and the demand response. And guess what? It was temporary. And so just this blip we're seeing right now is part and parcel of the pandemic on the supply side. And this, again, will be temporary. So I would just say that, look, I'm looking at the bond market right now, Barry. I'm looking at the strips. Come on. The strip curve is already priced for 2.5% Fed funds rate. We're already priced in the strip curve, okay, for peak Fed funds to the funds rate that Powell brought in December 2018, that he already has told us ex post was a policy mistake. The unemployment rate back then was below 4%, not north of 6%. And so that's what the market's priced in. The market's priced in that we're going to go in the next cycle and starting early back to the peak funds rate of the last cycle. I put extremely low odds that that's going to happen. And so I'm taking a look at the tips. You know, the tips curve is telling you that what we're going to get towards 2.5% on the 5-year break evens, 2.2. You know, you just showed that the core is at 1.4. And headline, you look at core because headline ultimately gravitates towards core. You got a lot priced in already, right? So, what if we don't get a sustained run up in inflation? What if the Fed is steadfast and says, no, we're not taking the carry away as you think we're going to, Mr. and Mrs. Bond Investor? This curve is already so steep. We haven't seen a curve this steep in 7 years. So a lot of what you're talking about is priced in or overpriced in. We might get a yield overshoot. If you're trading the market, you know what? I'm not your guy. I'm not a market timer. I actually have a technical strategist who works for me. You can talk to him. I take a look at the big picture. You're going to ask me. You're going to ask me, is this a buying opportunity in long treasuries? Absolutely.
So I love what you're saying. I think the people that are watching this love what you're saying. So I just want to summarize real quick, then I want to talk with you about the Fed. So like you see there being an interim spike in inflation, which, as we said, it's transitory. We showed that how that will start to back off and get inflation numbers back under 2% towards the fall, more than likely, depending on what the actual numbers come in. Remember, we're only assuming 0.2%. It would be higher if those numbers are higher, lower if those numbers are lower. But longer term, this is a period of time that we'll probably look back on and say, the mortgages that people are writing today during this period, even if we do get the spike, now we don't know if we're going to get a little bit of a spike in mortgage rates, and the 10-year depends on, as you beautifully said, less sophisticated individuals who can be influential that are in the market might drive prices up because all they're seeing is the prints, not recognizing as much that it's a backward-looking number and not being as insightful as seeing the numbers that we just went through, showing that it will eventually back down. But we could see a little bit of a blip higher, maybe pushing that 10-year treasury towards our target of 1.97 or call it 2% temporarily. Later on, rates come back down. And then longer term later on, meaning a year plus, maybe even towards the end of this year, we could see really attractive mortgage rates. So the loans that people are doing today could potentially be good refinance opportunities, and it'll probably make this hot housing market even hotter. Do you agree with that summation, David?
Well, firstly, before I talk about the housing market, although that's your area of expertise, the Cleveland Fed produces every month their own version of inflation expectations, and their 10-year inflation expectation measure right now is 1.4%. The market is at 2.2. There's an 80 basis point gap. So you can understand that if this inflation expectation somehow unwind, you're going to get a very significant bull flattening in the curve. Long-term rates will come down. Mortgage rates will come back down. And that's what I was saying, is that the market has one particular inflation forecast, but the Cleveland Fed, that's been around a long time, has its own inflation expectation measure. And the question is, which of the two are going to converge? You said something interesting before, which is about a recession 2022, 2023. Look, this is a stop and go economy. It's a stop and go economy. And we know already by the fourth quarter of last year, 60% of the economy had already returned to life. Okay, maybe not in New York, but 60% of the economy had already opened up. But what happened is that if you're taking a look point to point, because people say, oh, well, fourth quarter GDP growth was 4%. Well, that's the average. If you go the end of September to the end of December, you look at the monthly GDP numbers, we contracted at a 2.8% annual rate from September to December. And we already know that retail sales back then were negative 3 months in a row. Who was calling for that? And it's because the stimulus checks ran out of steam. Lo and behold, end of the year, President Trump signs on to that $900 billion stimulus. Oh, voila, what do you know? January, 5% retail sales. Coincidental? And now we're going to get a lot more stimulus. Again, it's a debate as to what's going to get saved and what's going to get spent, what will be used to pay down debt. Not all of it's going to go into the economy. But this is a boom-bust economy. Okay, Joe Biden has taken a boom-bust economy and taken it to steroids. All of this stimulus, this is not FDR stimulus in the 30s. This is not some new deal. Now, maybe we'll get infrastructure. I'm not so sure. And it's got a long gestation period in any event. No one's really going to notice it. But this is not like the New Deal. This is not like the 10-year Bush tax cuts, the 10-year Trump tax cuts. This is not the 10-year Obama infrastructure package signed in 2009. This is just all transitory. So it's going to give you huge growth, huge. Second and third quarter, it's going to be monumental, and then we're going to have a massive fiscal withdrawal unless they somehow replace. Like, are we going to get 10% private demand next year to replace the fiscal withdrawal? I can't believe people have actually been raising next year's GDP forecast. To me, that's incredible. I think unless all this fiscal stimulus is permanent and they can continue to roll it over. There's no way that even reopening the economy and all the demand that's going to create for airlines and restaurants and recreational services, it's just not going to be enough to offset this gargantuan withdrawal in fiscal policy for next year. To me, that's the overriding forecast for me is, what does the recession next year look like? So I'm going to say, if you look, depending on your time horizon, this sell-off in bonds, this is a gift from the gods. We like I said, we had 10 of these. We had 10 of these just like them. Growth, tax cuts, infrastructure, commodities, oil, sell bonds. And and the lesson last cycle, by the way, is that when you go up 100 basis points from the intermittent low, you want to start buying.
I love everything that you just said, David. And again, we're very pleased to see that, the ways that we've been thinking about how debt's going to impact us, how the stimulus is ephemeral. We're going to see it, just like you pointed out, the 900 billion by October, the effects are pretty much gone. When we take a look at this year's stimulus plan, big rise, but then it will start to really wear off. So we're glad that you think that our thoughts on a recession in 2022 aren't misplaced, that you think that we've got a real shot at seeing something like that. And even if we don't get that, it's reason to see interest rates be driven lower, and maybe even on the 10-year pressure towards the zero bound. I want to talk to you about the Fed, because first of all, just a question that I have for you personally is, the Fed keeps saying that they're buying $40 billion a month in mortgage bonds, but when you look at the New York Fed.org and you look, it's just an outright lie. They're buying well over 100 billion. They're buying like $30 billion a week. And before, they used to be very transparent about this. And I guess because we started calling them out on this all over, now they've taken a very clandestine approach. They say 40 billion and they used to show that they were buying 120 billion. But now you go to the New York Fed.org, a lot of this is erased or vanished. They don't really show a lot of this information. Can I ask you why they just won't fess up to it?
Well, I have, we already look, I'll just say that, after the last crisis, where the term maiden lane assets showed up in the Fed's balance sheet, very arcane line item that nobody really knew what it was. You knew at that point that it was becoming increasingly opaque. It's very interesting in that respect that when it comes to the components of the balance sheet, they become less transparent. But when it comes to verbalizing policy, they become increasingly more transparent over time. But I'm not really traditionally into conspiracy theory, so I don't have an answer for you. But it is a very interesting observation.
David, when we talk about the Fed and the size of the balance sheet, and then all of this debt that's going to come on the market, I would imagine that the Fed's going to take an even bigger role in monetizing all these 10-year treasuries. And hopefully some foreign participation comes in, maybe at the increased yields, there's a little bit more appetite. We're going to get a 10-year note auction tomorrow. I think it's really important on how that goes for the temporary move in rates for people to be paying attention to. But what do you think the Fed's going to do when all of this supply of 10-year notes and bills and bonds comes on the market? Do you think the Fed will up their purchases to monetize the debt?
Well, I don't think they'll have a choice. Look, we already have, we had a horrible 7-year auction coming on top of a very sloppy 5-year auction. We'll see how this week's auctions go, starting today with the 3-year. So, we're in an unprecedented territory here with the amount of new issue activity under the federal government. I can't even understand how people think that the Fed is going to taper. If anything, they might be forced to re-expand their balance sheet. And yeah, in terms of, in quotes, monetizing the debt, let's just say that this debt that is on the Fed's balance sheet is going to be there permanently. I mean, we know that from the last cycle. The last cycle, like, look, the last cycle was a 10-year economic cycle. The stock market quintupled. We had a $1 trillion deficit at the peak of the cycle, and record long duration for growth, wild asset inflation. And the Fed had every opportunity to shrink its balance sheet. Before the great financial crisis, what was the size of the Fed's balance sheet? It was like $800 billion.
Yeah.
So even in the best of times, 3.5% unemployment. We had 2% inflation for part of it. And what was the lowest point on the balance sheet? The lowest their balance sheet got was what, 4 trillion. The lowest that their balance sheet got was like 5 times the size that it was before the great financial crisis. So this is what we're living with. But look at, if you're taking a look at the European Central Bank balance sheet, share of GDP, the Bank of Japan balance sheet, share of GDP, I mean, that intervention is even larger than it is in the States, and who knows what the limit is. But I think that the Fed is going to. I don't think they're. The question is there enough institutional demand and retail demand to absorb all this paper? And I'm not so sure about that. Now, it may well be the case that the best thing that happened here was that households used their stimulus checks to pay down their bank loans. And so what did the banks do with all the proceeds and the reserves? Was they use it to buy treasuries. I mean, the fastest growing component on bank balance sheets outside of cash or treasury holdings, which are up like 40% year over year. So the question is going to be, how can the Fed afford to taper? Is this debt going to stay in the Fed's balance sheet through our lifetimes, both professional and personal? I mean, we live a long life, Barry, but the answer is yes. I think that this debt is here to stay in the Fed's balance sheet.
Yeah, I agree with you. And I want to talk to you about a dear friend of ours, John Malden, a mutual friend, both of us. We love him and respect how brilliant he is. He's talked about looking a little bit further down and talking about the Great Reset. I mean, I don't know if you think that that's something that could occur, because what is the solution for this, David? We've got, as you said, I think the number was 3.7 trillion we got down to on the Fed's balance sheet, and the market had the tantrum, the taper tantrum, and this is certainly not the Paul Volcker Fed. Okay, so Jerome Powell acquiesced right away, and the Fed came up, and now you've got not just Jerome Powell, but you've got Janet Yellen in the Treasury seat. So you don't even have a checks and balance system there. Is there a Great Reset? Should we be concerned about it? Should we be looking at things like gold and Bitcoin? What is your thoughts? Just look, no one knows for sure, right? But let's just kind of look a little bit further out there. What do you see as the end game, if there is an end game here?
Well, I always like to say, although it's a totally different culture, that Japan is really your template. Japan's total debt to GDP ratio is in the stratosphere. I mean, we're talking about debt to GDP in the U.S. at 120%. In Japan, it's close to double that. And you look at how long they've had financial repression in terms of zero rates and expanding balance sheets. I mean, they were doing QE long before Bernanke coined the phrase. Back in 2009. So, at what point do you press the reset button? What does the reset button really mean? I think that, the question is, will we go into some sort of financial crisis? Will we have a failed auction? Will there be a run on the dollar? Will there be some sort of destabilizing financial event? And that would force, as we've seen already, policymakers into action. But you can only imagine, where would we be if the Fed wasn't holding on to all this paper? If the Fed had intervened, where would we be today on the economy and on the markets? And there's some people that are libertarians that think that we'd be in a much better place. I mean, it's all counterfactual, but the concept of the reset button, I mean, Barry, I think that we've already pressed it. As you said before, you called it debt monetization. It's not really technically debt monetization, but we're getting there. On fiscal policy, what are we moving towards? We're moving towards. I mean, look at this. It's called the COVID relief plan, but there's so much in there to support incomes for working people. Now, maybe low, middle income working people, but these people are working. We're moving towards a universal basic income. We're moving towards a citizen's income. Society is changing. I mean, take a look at what the Fed's looking at right now. I mean, we were sort of rolling our eyes when Janet Yellen introduced her labor market dashboard back when she was governor. Look at the Fed is now looking at a whole range of they're looking at unemployment, gender lines. They're looking at unemployment on college attainment lines. They're looking at unemployment on racial lines. And so the Fed's taking on a very much of a socioeconomic objectives on top of everything else. Everything is changing right now. How the central bank is viewing the economy, its mandates, how fiscal policy is evolving. Like basically, you talk about a reset button. What do you mean, like a reset button? Like basically, Barack Obama unveils what today would be considered to be a really small infrastructure package of 800 billion. That's nothing. And the Tea Party was all, he just got excoriated, right? And today, when you're taking a look at this fiscal stimulus, all short term, most of it's not even going towards COVID relief. The public support for this is overwhelming, even as we're coming out of the COVID, right? So society is changing here. So, you talk about a reset button. Well, monetary and fiscal policy are going to be working together a lot more closely. We're talking about big central bank, and we're talking about big government. Like I think today, when I tell younger people about Ronald Reagan's famous line in 1980 during the campaign about the government isn't the solution to your problem, the government is the problem. No, today the government is the solution. So if we're going to have a big government balance sheet, we got to have a big central bank balance sheet. So when John talks about the big reset, well, we're resetting right now. We are resetting right now. And this to me looks semi-permanent. Now, if you want to identify what the financial crisis is going to be that causes, if it's a reset button, are we going to go through, like, for sure, if the reset button is about getting debt ratios down, well, the denominator is income. Well, we're not going to grow the incomes looking at the population profile. Demographics are going to work against that. Are we going to actually, as a society, pay down debt? Even though the household sector has been doing it, it's clearly not enough. And look what the corporate sector has been doing on their balance sheets. So it's going to come on the central bank balance sheet. And I don't know if this is going to end up being inflationary. Maybe over time it could prove to be stagflationary. I think that the one thing that I will say that's happened is that anybody's confidence interval over anything should be a lot wider as we all celebrate the end of COVID and we're going to go out and party. We're heading into a very uncertain post-COVID future.
Yeah, I know that, Megan.
And I'm actually thinking that these debts, when you ask me about what the outcome of these debts are, they're going to keep interest rates low, and they are anti-inflationary because they're a constraint in aggregate demand. And I don't know what the reset button is, and I don't know how. The only reset button I could see would be ultimately the debt jubilee, like not just debt monetization light, because QE doesn't operate that way, right? QE is operating through the secondary market and bank reserves. Debt monetization is something a little different. Now, if we go that route, if John Moulton's talking about debt monetization, outright debt monetization, which is when fiscal and monetary policy become real blood brothers, then we're going to get that big inflation. Okay, we're going to get that big inflation, and you want to be long hard assets and not just commodities. You want to be long farmland. You want to be long real estate.
But David, you don't think we're seeing some of that debt monetization right now?
No, we're not, because it's not the same thing. Debt monetization is a direct transaction between the central bank and the treasury. It's not operating through the secondary market. Look at the difference, okay? The difference is that when they're doing QE, like they're doing QE, they're coming to Barry Habib and they're buying your bonds. They're buying your bonds. They're taking your bonds away and they're giving you cash. What do you do with that cash? Well, there's different things you can do with that cash. But we're seeing that a lot of that cash is sitting on bank balance sheets right now. Look at the excess reserves in the system. A lot of that cash is sitting really in gargantuan excess reserves or the banking system's deposits of the Federal Reserve. That's why you're not seeing the inflation, right? Why is money velocity going down? Money velocity was not offsetting the monetary expansion. And that's why you're not seeing a lot of the big inflation. Now, I would say debt monetization would change all that, because that is not operating through the secondary market. That's
And
basically what's happening is that the Treasury is putting a $10 trillion perpetual coin on the Fed's balance sheet, and the Fed is actually printing money, bypassing the system, and the Treasury's got all that money to do whatever it wants. One giant, you know, cash for clunkers. So that's actually what debt monetization is, and it's more than a subtle difference. Okay, but so far the Fed's been doing QE, and we could see that despite the QE, and Bernanke was the architect. Where did the big inflation come from? QE. And it's because money velocity keeps on going down. It's because all this so-called monetary expansion is not turning over in the real economy. It's sitting in the garage. So you can create $1 trillion, have it sit in the garage. Did you create inflation? Debt monetization. Okay, so if John's talking about that sort of reset, that's the only reset I could see.
I got you. So
Yeah.
Megan, by the way, Ronald Reagan, it was, I'm from the government and I'm here to help. That was a famous line. So Megan, I know you've got a couple of questions for David, so go ahead.
I do have a couple of questions. So one thing that we tend to see normally when we start to see signs of inflation is gold does really well. Well, as you've likely been hearing in the media and everywhere, everyone's been talking about gold and how it's such a bad investment right now. So I'd like you to talk about gold, and then Barry also lightly touched on it, but I also want to get your thoughts on cryptocurrency as well.
Okay, well, gold has been undermined by two things. Firstly, rising market yields, because gold ultimately moves inversely with bond yields because it doesn't pay you a coupon. And specifically, the fact that a good part of this run-up in yields, initially it was inflation expectations, and more recently because of all the fiscal stimulus and the fact that the 1.9 trillion looks like it's going to go through and nothing less. So real rates have started to back up, and there's a huge inverse correlation between the direction of real interest rates and the direction of gold. That's point number one. Point number two is, well, you brought it up already, which is crypto. It used to be that, gold was the only store of value. Gold was only the hedge against financial instability or reckless central banks. Gold was the only asset that covered you for that. Well, all of a sudden you got Bitcoin, and that's served up as a huge competitive force for gold in that store of value realm. And you're seeing a lot of inflows. I've been a skeptic on Bitcoin, but the reality is that it's gaining a lot of institutional momentum as a gold surrogate. And so we ran some regressions on looking at the ETF flows. We found that the existence of Bitcoin has cost the price of gold at least $200 an ounce, that competitive force alone. And so I would say that, gold is not going to be in the penalty box indefinitely. And I do believe that when interest rates come back down, gold's going to do quite a bit better. But it still has that competing element from Bitcoin that we have to factor in as well. I think that if you had a situation where real rates come back down, and for whatever reason, we find out that, and Bitcoin absolutely plunges, gold is going to do quite a bit better, but that's what it's going to need to turn around significantly.
So David, Megan, I just want to just summarize a couple of things here because it's really good before you get your next question in there. So longer term, gold, longer term, long-term treasuries, good news longer term for mortgage rates, maybe longer term recession, but shorter term, while you're not trying to time things and you're not looking at the technicals as much, and as personally, there is the possibility that we could see things get a little worse as far as interest rate go, meaning going up and bond prices going down before they resume the trend that we've been in for so long. Would that be correct? And then Megan, let's take you. I know you had another follow-up question.
Yeah, look, Barry, I have a technical strategist on the team. We produce a weekly set of technicals. And I have that because, like you, I know that there's people that like to look at it. It's not really, part of what I do, but I offer that service, and I would say that you're 100% right. For the next 20 basis points, for what it's worth. Now, look, I talk to some people and I say 20 basis points, shrug my shoulders, and people look at me and say, "Are you kidding? That could be my entire year." So I'm not trying to like downplay 20 basis points, but I fly 10,000 feet in the air. I got to cater to people that have both feet on the ground. And I'd say that you're probably right. But let's say we go up another 20 basis points. I mean, most of the move is over. That's what it says to me. And what I was trying to say before is that you have a lot of inflation priced in. You have a full Fed cycle already priced in. I mean, unless you think the Fed's going to go to a new peak in the funds rate, I'm not there. So I'd
No,
say
we actually, this is really good news.
everything from here, this is what's relevant in my opinion. Everything from here is pure overshoot. Pure overshoot.
People are loving what you're saying. I can tell you right now, because it's very good news. Maybe for a short window here, we got to be on guard. But the good news is the information that we're giving to people is at least helping them have a strategy to navigate through the short term to reap the benefits of the long term. Sorry, Megan, I know you had follow up.
Well, speaking of short term and long term, I wanted to get your guys' thoughts on yield curve control.
Okay, well, I'll weigh in on that. So it's situational. Everybody thought that Powell was going to mention it at his congressional testimony, that he was going to talk about it again. Last Thursday, the reason why the markets became unglued is because he basically said, we're not that concerned about the run up in bond yields because guess what? It hasn't really tightened financial conditions. Well, that's code for the stock market, but it's really code, especially considering that Powell's a former credits guy, that credit spreads hadn't widened out yet. Remember what credit spreads did in those previous times, even in late 2018 when we had the Powell pivot. The credit markets froze up. Remember, the Fed is not going to be proactive. Everybody says the Fed's got my back. Yes. Powell has your back. After the dishes break, he'll pick up the pieces, okay? He's not going to be proactive. So he's waiting for financial conditions to tighten, which means credit spreads widening out. Credit spreads widen out, and they're going to come in and either do more QE or they'll do yield curve control, which they've done in the past. They did it for 9 years in the 40s and 50s, and Bernanke did it twice, right, Barry, in 2011, 2012. So they will come in at some point, but it's going to depend really on how the markets behave over the course of the next little while.
What about all this talk about Operation Twist? Do you think that this will be brought up next week when the Fed speaks?
It could be brought up, but like I said, the same thing with with yield curve control, where they cap the longer end, or Operation Twist, which is really not a cap, but they sell, they have a lot of treasury bills they can sell to extend out the curve, and of course everything's priced off the 10-year part of the curve, so that's what everybody focuses on. All this stuff, whether it's going to be re-expanded QE, I don't think they're going to taper. I think the next move will be that they will be expanding quantitative easing. Yield curve control, Operation Twist, all these things I think are on the table. You see, we never know what they're talking about behind closed doors. I'll tell you this much. I did this when I was at Merrill Lynch to show you how much time I had on the tarmacs back in those days. I used to look at the FOMC minutes and then look at the transcripts and see what was similar. And when you look at the transcripts and you look at the FOMC minutes, most of them don't look anything like each other. You don't know what they're talking about behind closed doors. So what I'll say is that it's going to be situational. And I would say specifically, and I'll say this much, if you go to the last monetary policy report that the Fed published before Powell's most recent congressional testimony, there was a lot of references to their big concerns, which are in leverage loans, commercial real estate, balance sheets of small businesses. They're very concerned about wide swaths of the corporate credit market. That's a big concern to them. That's why this backup in interest rates, if it has some sort of nefarious impact on the economic outlook with or without the stimulus, and you start these spreads widen out, that'll be to me, that will be the leading indicator for the Fed coming back in and doing something, whether it's yield curve control or Operation Twist. Operation Twist is easy because they have a ton of short-dated bonds on their balance sheet that they could term out, and they've done that before. That's the first thing that they'll do. But once again, they're not going to lead the market. Okay, so if you're telling me what he's going to say next week or next 2 weeks, tell me where spreads are, and I'll tell you what the Fed's going to do. But they're not going to move in advance of that.
So David, can you talk a little bit more as we move to wrap this up here, just for people that are watching, just credit spreads. Talk about that, what you're looking at there. And then the last question I'm going to have for you is, what's something that's on your radar now that you're thinking of that could be a big deal that we should be paying attention to that most people aren't? So first, talk about credit spreads.
Well, look, they've only started to widen moderately, and I'm talking about, you know, either look. I mean, I always look at the high yield market first. That's usually the canary in the coal mine, and only recently have they really started to move. But I think they'd have to widen out from here, like at least 75 or 100 basis points. Okay, so we're far away. We're far away from that.
And I just wanted to explain to everybody, just so everybody follows what David's saying. So when we talk about the spread in the yield curve, that's different maturities spreading out. But the credit spreads is credit quality, where you have, you know, your super A tranches, and then, you know, you go to, which is the government-backed debt, and then you've got things like mortgage debt, then you got corporate debt, then you've got your more riskier debt, and they've kind of been crunched up together, right, David? So you're thinking like the canary in the coal mine, the first sign to watch out for, similar to like we saw, I believe it was in 2008, it really started to send some warning signals out there, was when you saw the spreads widen between what people thought was, you know, higher risk, and they demanded a higher premium, right? I just wanted to set the table so everybody understands what you're talking about.
That's right. Look, it is that is really, when you're talking about the canary in the coal mine for risk appetite and leading indicators for other asset classes. High yield spreads are really, they're a bellwether. Okay. Spread product in general. I mean, look, your world is spread product too. It's in mortgages, but a little safer than the speculative grade bond market. But look, when you go back to that period, you know, back again when I was at Merrill back in 2007, spreads were widening out before the stock market figured it out. So you want to pay attention to spreads of all type, because that's really the pulse of risk appetite. And when the Fed is talking about financial conditions tightening, that's code for credit spreads. It'll feed into the equity market. And so in terms of, you know, what am I looking at, or what's my fundamental disagreement with the market? The market's already laid down its cards on its view. And the view is that most of this fiscal stimulus is going to get spent in the real economy. It's going to have multiplier impacts in 2022, and that we're going to have this as the economy reopens because of the vaccines, and that we're going to have the two situations coexisting: the reopening of the economy in full and all the stimulus. And I'm saying that, look, I think second and third quarter growth is going to be very strong. Where I disagree with the market is that I don't see any multiplier impacts from this. This is all transitory. So the big, I guess, difference between me and the market is that I'm not looking at what's happening on fiscal policies being permanent. And I don't think an infrastructure package is going to change that. You know, I say to people all the time, show me what quarter the Obama infrastructure package showed up over the previous 10 years. Can you show me the quarter that it showed up? What part of the business cycle did that show up? The gestation period is so long. So I would just say that I think that the market, if the market looks ahead 3 to 6 months, then I say that at some point in the summer and fall, it's going to have to confront the 2022 outlook. We would have priced in the massive growth, best growth since either 1973 or 1984, take your pick, or 1966. But at some point that gets priced in, and it probably is already. I think that the problem comes when we start to price in 2022. We see the emperor has no clothes. We understand that all that's happened here is that the Biden team has generated the conditions for a boom bust economy. We've got the boom, it's priced in. So I'm looking at trying to stay ahead of the curve. And look, it may be early. Maybe it's too early. But you know what? I cut my teeth at Merrill being too early on the housing call, and it proved to be spectacularly right. So I'm trying to stay way ahead of the curve here and say that what's not priced in is what you're talking about, Barry, when we first started on this call, which is that we're going to have unprecedented fiscal withdrawal, okay, next year, and it's going to have a huge impact on GDP. Inflation is going to come crashing down. That's not what the markets have priced in. Markets have priced in the roaring 20s. I just heard a report, I called it the boring 20s. There's no roaring 20s. There's no roaring 20s coming.
Th-
This is a stop and go economy, and we're go right now. And the next move is going to be stop, but the market doesn't have that priced in just yet.
David, first of all, I love you. By the way, what do you think of our Yankees chances this year? David and I have gone to a few Yankee games together. We got to make sure we do that this year. I like our Yankees chances this year.
I like them too, but let's hope that the Yankees call is better than my equity market call. Okay.
Well, you know what? It's okay. You're always brilliant, and you've added so much value. I know Megan wanted to follow up with some information for everybody watching that wants to get more in touch with you.
Sure.
Yes.
Well,
so
great.
everyone has been asking for more information, and David, I'll let you give your contact information or whatever you want to give after this. But David was kind enough for all of us listening to get a 30-day free trial to his services. So I'm going to go ahead and I'm going to post that link in the comments, and definitely be sure to take advantage of this. I have learned so much from you over the years, and I personally just want to say I appreciate everything that you do.
I appreciate it too. I appreciate our friendship. I appreciate your wisdom, and I love you, brother.
Well, you too. And I just want to say it's a free trial to show you that I'm talking my disinflation book. Okay, putting my money where my mouth is.
Well, thank you, and thank you everyone for tuning into this Facebook Live. We'll see you next time.
You bet. Thank you.